I'm sharing my screen now, and I'm expanding the PowerPoint. Welcome everybody. Grateful that you're with us today. I'm excited for this topic. Seems to be a pretty hot topic. This is our quarterly Financial Insights webinar. We'll be talking about the Trump tax code and your IRAs today. I am recording this webinar so that we can put it up on our website. You can go back and revisit it, and we can send the link out to those that wanted to attend but weren't able to today. I've got everybody muted at this point. At the end, when I stop the recording, I'll unmute everybody. Those that have questions, we can ask questions back and forth for a little bit. So again, the topic today is the Trump tax code and your IRAs. I sent out handouts for this webinar. One of them is entitled the Trump tax code and your IRAs. It looks like a quiz with 10 questions on it. This is a good way for you to take notes, since these questions will be answered as we go through the webinar. And at the end of the webinar, I'll give you the answers, and you can grade your own papers. How about that? All right. First of all, obviously, our attorneys want to get involved. So they've asked me to read this disclaimer. So this material is provided courtesy of W.J. Reeves Financial Group and contains general information to help you understand basic tax planning strategies and considerations. Nothing I say should be construed as a recommendation to buy or sell any financial vehicle, nor should it be used to make decisions today about your own personal investments. I am a CPA, PFS, a licensed insurance producer, and an investment advisor representative of W.J. Reeves Financial Group. My goal today with this presentation is to expose you to ideas and financial vehicles that may help you work toward your financial goals. Please understand that I cannot make any promises or guarantees that you will accomplish such goals. Investing involves risk, including the potential loss of principal. Past performance is no guarantee of future results. This is starting to sound like one of those commercials where I'm supposed to talk at 2 times speed, but I can't talk that fast. Neither the firm nor its agents or representatives may give legal advice. You are encouraged to consult with a qualified professional before making any purchasing or investment decisions. Despite efforts to be accurate and current, this presentation may contain out-of-date information. We are under no obligation to advise you of any subsequent changes related to the topics discussed in this presentation. Many of you in attendance today are not current clients of W.J. Reeves Financial Group. Following this webinar, you may reach out to us to schedule a time to visit with us one-on-one to discuss your specific circumstance. There is no obligation to you for this visit or at this visit. During this visit, you may be provided with information regarding the purchase of insurance products or establishing an investment advisory relationship. Okay, we got that out of the way. Let's get busy on the webinar itself. Before we get too deep into the topic, just keep in mind that a comprehensive retirement plan includes more than just tax planning. It involves income planning, investments, as well as tax, healthcare, and estate planning. Today, we're going to focus on the tax planning side of things. Please understand that planning in any one area of these affects the whole. So I'd hate for you to implement something we talked about today and then get an outcome you weren't expecting. So make sure to work with us when implementing any of the strategies that we discuss. So let's take a look at what we're going to be discussing today. We're going to talk about qualified retirement plans. That includes IRAs, 401ks, and how these plans often lead to tax-related problems during retirement years. They're great while we're working, not so great when we're retired. The new Trump tax code offers you a number of opportunities to save significantly for a limited period of time, because there is a sunset provision in the code. And we see a very large percentage of people who are either retired or retiring soon that are making big mistakes with their planning. So question number 1, right out of the chute, and I sent you should have received handouts for this as well. How does saving tax on $155,000 of income lead to paying tax on over $1 million. So let's look at what we sent. I sent this handout to you. You should have this. But on the left-hand side, you have the growth and accumulation phase, which is during your employment years. And this chart is just showing starting at age 35, going to age 65, contributing $5,000 a year into a 401k type plan. The earning rate here is 7% a year. Obviously, that's not going to happen in reality, but for illustration purposes, this is just showing contributing throughout your working career $155,000. See that at the bottom? So that $155,000 was deferred from your pay, so you did not pay taxes on that $155,000 as it was contributed into your 401k plan. Now, during your retirement years, on the right-hand column, we're going to have to start taking money out at 70.5. These are required minimum distributions required by Internal Revenue Code. And after about 16 years, we've withdrawn $529,500 in this example, and we still have a balance of $632,000. So as this money comes out, this $529,000 and this $632,000 that comes out at death to your heirs, that's total taxable assets or income of $1.1, almost $1.2 million, when we just deferred tax on the $155,000 of income when it went in, back on that left-hand side. So as if that weren't enough, IRAs have several more problems as well. Every distribution that comes out of an IRA is taxed at your highest rate. And distributions sometimes put us into a higher tax bracket. And more often than not, number 3 there, more often than not, these distributions lead to additional tax on your Social Security income. And distributions sometimes lead to more tax on our capital gains. They bump us up into a different capital gain rate. And number 5, these types of accounts are the only type of accounts that require distributions, starting at age 70.5, whether you want the money or need the money. And these types of accounts are the highest taxed accounts that we leave to our heirs. So what result are we looking at? These qualified plans, IRAs, 401ks, 403bs, often cost more in tax than you ever planned on. I think we gave that illustration already. During your retirement years, you could easily argue these are the least tax-efficient accounts that you own. They're awesome during our working career because we're deferring income taxes as we're putting away, and they're great for the accumulation phase. But during retirement years, these are the least tax-efficient vehicles or accounts that we have. So how can the new tax law changes help us? Well, the key is to understanding the new brackets. So here, and I'll walk through this a little bit, and this is for the single taxpayers, and then this one is for our married taxpayers. So I'll spend some time a little bit more on the married, since most of our clients file married, filing joint tax returns. So in the left-hand column, you see the 2017 tax law, and on the 2018 is in the right-hand column. So you see that the 10% tax bracket essentially stayed the same. We had a cost of living adjustment slightly there on the taking the $18,000 up to the $19,000 for the top end of the bracket. But then the 15% tax bracket in the old law is now a 12% tax bracket. The 25% is now a 22%. The 28% is now a 24%, plus the bracket itself has expanded significantly. The old 28% tax bracket ended at $233,350, and now the 24% tax bracket goes all the way up to $315,000 of taxable income. The 33% tax bracket is now 32, but remember the 32 doesn't start until 315,000. Goes to 400. The 35% bracket remained essentially the same, but it extends clear up to 600,000. And our top bracket now is 37% instead of the 39.6% that it used to be. Also, our standard deductions have almost doubled, but our personal exemptions have been eliminated. Okay, so that's a mouthful, but the key piece is understanding the brackets here and how those have changed. And it makes a big difference as we do our planning. So one of the best ways to reduce the tax liability on our retirement accounts over time is to pay some tax today at the new lower rates and shift money into a Roth IRA. So we're essentially moving from a tax-deferred bucket to a tax-free bucket. In order to do that, though, we're paying tax as we move the money from an IRA, from a traditional IRA to a Roth IRA. Now, why would you want to do this? Well, let's look at these benefits of converting some of our money to a Roth. Number one, it allows us to have tax-free distributions going forward after we've followed all the rules. If you're over 59.5, you've got immediate access to those funds with no penalties. You no longer are subject to the required minimum distribution rules at age 70.5. You could pull the money out when and if you want to or need to, and your heirs receive it tax-free. So you are also, for this particular type of account, you're immunized against future tax law changes. Now, in our practice, we advocate not only having a diversification of investments, but we also advocate having a diversification of our tax ramifications. So we've got tax-free accounts or vehicles, we've got tax-deferred, like our IRAs and 401ks, and then we've got those accounts that are currently taxable, where you're getting a 1099 every year. So we like to have diversification with our taxation as well. So let's walk through an example. Now keep in mind that everybody's different, but here's an example that we'll walk through. This is a married couple, both are 65. They are at the top of the 15% tax bracket in 2017, and their goal is to convert $200,000 of a traditional IRA to a Roth IRA. So in 2017, if they did this, their cost of the conversion would be to bump them into a 28% tax bracket, and that would equal about $56,000 of tax on that conversion. But in 2018, the cost of conversion now is 22%, or $44,000 of income tax. So we've saved over 20%. So is it a good idea to convert IRA dollars at less than 25%? I think many would probably say yes. But let's be aware as we go through this. We've got to be aware of some of the gotchas that are out there. So don't rush out and start converting to Roth IRAs, because you need to watch out for potential tax situations and Medicare premiums. Extra premiums on Medicare can be charged if your income goes over certain amounts. So when you do a Roth conversion, the amount you convert is included in your overall income. That number then is used to calculate what you pay for your Medicare Part B and Part D premiums. So a Roth conversion can often increase the premiums you pay on these benefits for a year or two. So everyone's different. Remember that. Take advantage of coming into our office and taking a look at doing some tax planning and see how that would impact you in your specific personalized situation. I have not seen a situation that is exactly the same for any of my clients. So it's important to do this individual by individual. I'm just giving general overview today in this webinar. And also remember that taxation is just a part of our comprehensive retirement plan. It's not the entire piece. So let's make a transition now to the number one mistake that we see people who are either retired or nearing retirement. And that is not understanding that investing during retirement is different than investing for retirement. Remember, investing for retirement is accumulation. During retirement is either preservation or distribution, or a combination of the two. So when clients come in to see us, they usually give us 3 rules. They want us to follow these rules: protect my principal, give me some income, and if you can, grow it a bit. I think if we asked all of you to raise your hand, you'd probably say, yep, those are my rules too. Unfortunately, what you want is one thing, but how your money is invested is another. So what you see on the screen right now is a pretty typical example of what the financial industry would call a balanced portfolio. You can see that this person has an investment mix of approximately 60% stocks, both domestic and international, and then about 40% in bonds. And this, again, is known as the classic balanced portfolio that is often recommended as you go into retirement. So why'd they invest this way? Well, they wanted to reduce their risk of losing money. And their goal was risk exposure of a 10 to 15% downside in a bad market. But unfortunately, the report that we showed previously has another section that tells us that while these folks have averaged a 6.38% rate of return, you see that in the upper right-hand corner over a 10-year period, not including any advisory fees, they also saw a 26.11% decline of their account in a single year. If you go here to the worst, where it says worst percentage, you come down that column, 1 year, the worst 1 year was a 26.11 decline, and that was during the financial crisis of March 08 to February 09. So we asked them how they would feel if this happened to them today, and you can imagine their response. Remember, they thought that they were setting their portfolio up to protect them to a maximum of 10 to 15% on the downside, and we're showing them that their portfolio would actually go down 26.11% in that worst 1 year. But you know, retirees aren't the only ones with these same 3 goals or rules that I mentioned. Think about endowment funds. They want to protect their principal, distribute income, and grow their accounts, don't they? So how do they invest their money? Let's look at it. We've got data from 2014 and 2015, and it looks like here that they are investing in domestic equities 15 to 20%, fixed income, which would be your bonds, would be about 10%, international equities about 20%, then alternative strategies about 50%, and then they've got some short-term treasuries and cash being about 5%. And I'm making rounding numbers here. So it seems like the key is that they've got about 50% in these alternative strategies. And so you're thinking, well, what are these alternative strategies? Well, it could be real estate. It could be commodities, life insurance, fixed index annuities, covered call writing, structured notes, reinsurance, enhanced yield lending. Okay, one of the things that I wanted to point out, and I just put my hands on this right before we started the webinar, so I don't have a slide prepared for it. But Kate and I attended an industry conference back in April, and one of the speakers there was Robert Ibbotson, PhD. He's the chairman and chief investment officer of Zebra Capital Management. He's also a professor emeritus of finance at Yale. And he was one of these speakers, and he handed out a study that they did. They did a great study. And he actually knocked the 60-40 portfolio that I just reviewed. And he said a 60% equity, 40% bond is far inferior to a 60% equity and a 40% fixed indexed annuity strategy, for example. And that's the one that he focused on. I'll read you one of his concluding remarks. He says, fixed indexed annuities have many attractive features as both an accumulation investment and as a potential source of income in retirement. In simulation, the fixed indexed annuity performed better net of assumed fees than long-term government bonds. We showed the fixed indexed annuity had comparable volatility to bonds, but with better downside protection. In our study, the bonds underperformed. The fixed indexed annuity performed quite well. It is our view, considering today's low interest rate environment and our modest expectation for bond returns in the coming future, fixed indexed annuities are an alternative to consider. So that's why they're on this list. Fixed indexed annuities are an alternative that fit very well into a retirement portfolio. So how does your retirement portfolio stack up? Are you taking on more risk than you realize? Do you know what your downside is? If the financial crisis were to happen again, do you know how it would impact your portfolio? And are you comfortable with that? So let's recap. IRAs, 401ks, 403bs, those tax-deferred accounts often create tax problems. They can and often do create these tax problems during retirement. We just need to do some planning to make sure that we're comfortable and aware of what those are. The new tax code offers a window of opportunity that some of my clients need to take advantage of, and we're meeting with you as we go through our reviews. And many investors are unknowingly taking on more risk than they should. So for those of you who are not clients, and even those that are, if you'd like to sit down and review your tax situation and make sure that your portfolio is meeting your needs and expectations, reach out to us. 281-990-8228 is our phone number. I'll repeat that. 281-990-8228 is our phone number. You can contact me directly via email, weldon@wjreevesfinancial.com. I'll repeat it, weldon@wjreevesfinancial.com. Thank you very much for attending. I will stop sharing the screen. I'll stop the recording